thank everybody for being here. This is one of my most favorite gathering of clients. Right? And the only difficult part is I don't get everyone as much time as I want to. But anyway, I thank you first of all for all coming. Some of you who haven't seen me since April may not recognize me. I don't have a mustache after 40 years. And I didn't realize how much different it made me look. So, but some people kind of look at me like,
You've lost weight, Steve.
I lost weight. And a mustache. But anyway, yeah, thank you.
I'm proud of you.
Thank you. So I'm pleased people are here, and I asked Jenny if I could tell this story. And this, one of the reasons I want to have people come, obviously it is social, you know, I have clients that want to come every year because that's the only time you get to see the people they saw last year at the event, which is great. But it's more for you to come and kind of touch the cloth of the people pulling the levers on these investments, right? So sometimes diversification is more than just how much in stock, how much in bonds, but who's pulling the trigger, you know, on these different things. And just to give you an example, Adam Evelor, many of you know if you've been in Rochdale for any length of time, he was a manager for years. And Ginny Steelman was always soft-spoken, quiet. You never know what she's thinking. Went up to him after the first time we did it and said, you know what, you're a little too young to be doing this stuff. You know, just by looking at him. Which he took well. And then about 4 years later, 4 meetings later, she went up to him and says, you know, you're getting smarter. And Adam said to her, no, the truth is this, Ginny. You've been coming for 3 or 4 years. You've been listening. You've been asking questions. You better understand what it is we're doing. So you grasp it better now. That's why I look smarter to you. And that is kind of really why we want people to come and to hear somebody speak to you about these things. What are they doing? What are they thinking? How do they process all this stuff? So that's kind of the thematic part. Now, Adam left and handpicked Nick to be our guy, who has, in my opinion, we're always nervous. We get comfortable with somebody, and as a portfolio manager, I should say, Adam had an opportunity to go someplace and be in a position to have an ownership interest. So it made sense for he and his family to do that. So, and he's very talented, and it made sense. And the Brophy Wealth clients all have the same portfolio manager, because they know how we think, what we expect for our clients, the access that we want for ourselves and for our clients to the manager. So Adam handpicked Nick. Nick has really, really impressed each of the wealth managers with how he's been handling the portfolios and some of the things that he's been cracking into. And but unfortunately, no, fortunately, his wife is having twins, and it's a little bit of a problem pregnancy. So there's no way he's traveling. So unfortunately, his boss had it. Now,
It's good to know who wants to stay in.
good.
This is a wonderful introduction here.
Well, I don't want to be too much out of it. Paul Guerney, I was asking, can I say Guerney? You Frenchman? But no, it's Paul Guerney. He's been with City National Rochdale since 2001. And he knew Adam well, still knows Adam well, knows Nick well because he was part of hiring those two. And Paul's responsibility includes, beyond just managing portfolios, but working with many of the portfolio managers there to help them craft different kinds of portfolios and specialty needs. So he actually is pretty well aware of what's in the portfolios of the people in this room. Not by name and stuff, but he knows how they're crafted and constructed and how they're being used. But you have one designation I hadn't seen before, and that is what is this? A Chartered Alternative Investment Analyst. That's like, yeah. So, alternative. So alternative means something that doesn't necessarily go up or down when stock goes up or down. So it kind of moves alternative ways. That gold is an example, maybe of something because gold is going to move up and down based on fear or greed, not necessarily because the dividends got better or their product got better, but it's an alternative. And as markets really get high, you start to wonder, well, does that mean the fall could be harder or whatever? So alternatives belong in portfolios, so it's good. Some of our clients, we do have the cliff water as an alternative, and This is an example of an investment that is illiquid. You can only get in and out on a quarterly basis. So it doesn't go up and down every day with the newscast. It's just and it pays like a 9% dividend. And for many clients, that's something good to have in their portfolio. So we're always looking for these type of things. So anyway, I don't want to take time from Paul, but I do thank you for coming here and trying to fill Nick's shoes. And he's gonna just kind of talk, but always we love questions. So let him know what you're thinking and what your concerns are, or what you're not clear on, and you get to have an opportunity to see how the person pulling the levers thinks about these things and get your comfort level. Okay? And you don't need this.
I think I do need this, right? Yeah. Sarah's nodding. I need this, right? Yeah, good. Okay. I'm told I can't leave the confines of the carpet, so I'm going to stay right here to make sure I'm in frame. Right? Yeah, this is going to be too hot. It's August. We don't need that, right? Okay. Well, thank you for that introduction. That was terrific. I'm actually thrilled to hear all of those good words about Adam and about Nick. I love them both. They've been working with me for a very long time, and I'm proud that they both carried on a terrific tradition here, and you've done a great job, and they've done a great job for you. So hopefully I can fill in at least a little bit here. So what I'd like to cover, and what I'd like to cover with this is, and I'll just structure it this way. I'll do a little bit about the economy, what we think about the economy, what we think about corporate profits, what we think about interest rates. We'll go through kind of those big main topics there. Just cover current events and how that's landing on it, what we thought at the beginning of the year, what we think now, did that change, where are we generally. I want to bridge that into what does it mean for investments, what type of investments work in that environment, what do we recommend, where would we put emphasis, where would we de-emphasize, which is another piece of that. Then we can talk a little bit about anything you want to talk about, right? So I'll take questions. We can delve into any current events or topics or specific things. I'll probably bring some of those up, right? Tariffs might be a thing we talk about. I'll mention it. You've heard of it, right? Okay. Okay. Interest rates we'll talk about. So we'll go through that, but I'll start high level, and then we can dig into whatever else we want to dig into through the Q&A. So I'll just start it here and say that looking at the economy, looking at the profit environment, corporate profits in the U.S., looking at the interest rate environment, we actually have had since the beginning of the year and still have a positive outlook, right? The economy in the U.S. is going to grow, we think, somewhere in the maybe 1.5 to a little bit more or a little bit less range. So I'll give it I'll just say 1.5 is kind of the central point there. Maybe a little less, maybe a little bit more. Our initial thought on that, go back to January or December, was for possibility for more growth than that. Right? We thought it might get to 2.5, 2.5. We cut that back a little bit. Why did we cut that back? We cut that back because some of the uncertainty around tariffs is one thing, geopolitical is another. Third one would be the tax bill that just got through, right? That just passed. Those uncertainties, as they were unfolding over the course of the beginning of the year, had an impact, right? Businesses just sort of pulled back a little. I'm not sure, so I'm not going to hire, I'm not going to build, maybe I'm not. That little hesitancy created a little slack. That was it. Consumers really didn't hold back, so we're looking at that and saying, okay, yeah, maybe a little less economic growth than we thought, but still a good number overall. Positive, good for corporations, good for businesses, a good business environment. The same thing happened when we looked at what we projected out to be corporate profit growth for the U.S. businesses. So we looked at corporate profit growth at the beginning of the year. Corporate profit growth is made up of a few different components, right? Can businesses expand their margins? What will the economy do? What type of inflation is there going to be? What's the dollar doing, right? There's components to how you come up with an estimate of what you think profitability, growth in profits will be year over year. On that a major component of our outlook, initially we thought, boy, profits look really good relative to last year. We could see 10, maybe even 14 or 15% growth in profits. Now, if you're keeping score at home, if profits grow 10%, right, all things equal, we would think that would be like potentially a plus 10% market, right? If the US profits can grow 10%, why couldn't companies be worth 10% more than what they started the year? That's kind of the little bit of the thought process behind that. Okay, so come to August, and what are we thinking about? We have a couple quarters in the books. The number's still going to be pretty good, but more like 7 to 10, right, is where we are now. We're closer to about 7.5. I think the broad consensus is about 9, but somewhere in that range. So a little less profit growth than we initially thought. Again, same rationale. The economy is grows a little bit slower, a little bit of hesitancy on businesses, consumers, all of that trade disruption we had for a little while. So profits positive, a little less. Growth positive, a little less than when we started. So if any of you follow along in our we publish monthly, and I've been looking at the chart for 25 years, monthly for 25 years. It was a long time. We publish those speedometers and we color them, red and yellow and green to kind of tell you what we think, a little heat map of the economic financial market environment. When you look at them today, it's like there's 2 green, there's 2 red, and everything else is yellow. Out of 20 things, we've got literally 16 yellow, which for me doesn't give me much information. I kind of think, well, what does that mean? Which way is that going? I'm here to tell you that when you look at that and you say, what does that mean? That means it's just an okay economy, and it's an okay profit environment, and everything is just fine, which is a very boring thing to say when I go to meetings and when I talk at these events. It's totally fine. If you think about what's gone on in the markets, it's way more exciting than just saying everything is fine, right? It's totally been a fun and interesting year, and we can talk about that in a little bit. So on those two, positive. Now, the third and fourth components of our kind of major market and economic indicator forecasts are inflation and interest rates. So on inflation and interest rates, we thought August? Thought in January it would be modestly higher. CPI, Consumer Price Index, would be modestly higher for the full year than where it was for the full year 24. Full year 24 was just about 3%. We thought it would be modestly higher than that this year, 3.25. No, not a big deal in any way, shape, or form. We still think it's going to come in about the same, 3.25, maybe 3.5, but modest change there, which for us, because you take inflation, you put it into your corporate profit mix, but you also put it into your economic outlook, but you also stick it into your interest rate outlook. So when it comes to interest rates, inflation's a big component about it. You probably heard about this. You're seeing it in the news, right? It's the fun. Some of the fun stuff that goes on now is we do have an administration that's a lot more vocal than the one before about lots of things. Interest rates has been one that's front and center. There's a lot of all caps, truth socials out there or whatever. The reality of interest rates is inflation drives it, but that small change that we see, and that is actually what's been seen in the data, leads us to the same outlook that we had at the beginning of the year, which is that the Fed should and likely will modestly cut interest rates, the Fed funds rate. They had a drastic change to Fed funds in 2022. You may or may not remember that. I don't want to remember it. It was a ridiculously tough year to manage money because it was essentially a 3 standard deviation event in interest rates. That had not happened before. You probably talked to Nick about it or Adam about it. I can't remember. Adam probably. It was a 3 standard deviation event in bonds. Right? That never happens. Never happens. Had never happened. You go back, 50 years or further, didn't happen. So post that, rates were very high. Fed funds rates were very high. They finally started to trim them last year to get them closer to a more neutralized rate, and get inflation under control. This year we thought 2, maybe 3 cuts. I think the market today has at least a cut at this next meeting at like 100%, and probably 1 more. So probably 2 cuts on Fed funds. The 10-year Treasury, which is really the benchmark rate for mortgages and everything else, that ended last year at 4.6. We thought that should be somewhere around 4.25, right? So down about 25, maybe 4, so 25 to 50 basis points, quarter to half of 1% lower. That's where it sits today. It's at 4.23, I think, when I looked at it. Again, modest lowering of short rates and long rates, given the economic outlook, the control on inflation, and everything else across the board. So when you think about that entire thing that I just laid out there, that for us is a nicely investable market. Stocks look good, profits are going up, right? Economy's going up. That's a positive for the stock market. We would say, okay, that's great. Stock market can do maybe not what it did last year, which was a bit of a recovery and other things, but at least in line. So kind of high single digits for stocks, we thought, at the beginning of the year. Bonds, with a modest decline in rates, the bond market should see prices go up a little, but at those levels of interest rates remaining relatively the same, it's kind of a quiet year, but a good year, because your base rates for bonds is somewhere in the 4%, 4.5% range. So when we think about bonds and stocks, we came into the year thinking, pretty good year. Actually thought it would be a pretty uneventful year in that regard, right? We just kind of go through and it'd be bump, 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 bump. It didn't turn out to be uneventful, but the fundamentals have not changed from the beginning to now, right? Slight decline, slight changes, but the base is there. Positive, and then a slight lowering of interest rates. So that's that kind of the high level story. Couple factors that we're thinking about. I'll give you some of the negatives, some of the positives, and then anybody who wants to ask a question in a minute, I'll let them raise their hand while I continue to drone on a little bit. When you thinking about the negatives on our chart, one of the big ones is geopolitical risk, right? Geopolitical risk is always there. And I'm going to say, I say this for context, we have that yellow, green, red dials. The geopolitical risk dial never turns green. Has never turned green. I don't think it will ever turn green. It's either yellow or red. It mostly sits in red because there's always something, somewhere, that we're in some kind of conflict about, or someone's in a conflict with us, or they're in a conflict. There's always something. The last few years, we've seen a lot of this. The key thing to think about when it comes to geopolitical risk, and this is the hardest part of it all for us, it's not the humanity of it all, right? When we sit there as investment managers, it's not that we're looking at. What we're really looking at is, what is the event? Is that event driving consumers to do something different than they normally would have done? That's the hardest thing really to center on, but it's what we, from an investment perspective, have to think about, right? So the question we have to ask is, there's a conflict in the Ukraine. Okay, we know what it is. We're all seeing it. We're witnessing it. It's terrible. If that means that this event is half full because people wanted to stay home and watch TV, they didn't want to go to the event, they don't want to spend the money, they don't want to go on vacation, that's a real economic, real financial, real corporate profit impact to a geopolitical event. That's something we really have to understand. If everybody does whatever they were doing before and they say, that's terrible and the difference is, what does the consumer end up doing? What does the business end up doing? Do they stop? Do they continue? And at what pace? And what is the impact? So with all of the geopolitical events we had coming into the year, of course there can always be escalation in that, but none of them were impacting the consumer. When you look at the consumer numbers, that's why the economy is positive, that's why there's inflation, because people want to buy things. It's moving in a plus direction, driving the economy forward. So I get asked this question all the time. They say, Well, with all this going on around the world and all this tariff stuff and all these other things, how come the market is going up? How come, we're not in it feels terrible. I watch the news, they're telling me things are bad, but the market's at an all-time high and this stock hit an all-time high. And that's where I have to back off and say, you got to look at the fundamentals of what people are doing, not what's being broadcast on the TV. So it's almost like you got to kind of turn that down a little bit and say, did the tariffs really have a big impact on what consumers did? Not really, right? It was quick, it was fast, we're going to do this, we're going to do that, we're going to back it off. By the time any of that and all of that filtered through anywhere, it really didn't have any tangible impact, right, that you felt in April, and this is a good example. April was a great example. So they make an announcement, nothing really happened, no one collected a penny, and the market goes down 20%. Globally huge. $8 trillion of loss on the market in a week and a half, something like that, a few days. The entirety of the problem that, as we assessed it, might have been, at maximum levels, $700 billion a year of taxes, extra taxes that businesses are paying. $700 billion at max. The market removed $8 trillion, so 10 years worth of taxes in literally a week. That is what the market does. It is a terrific overshoot to the downside. Market overshoots to the upside too, gets too enthusiastic before it should, but gets too pessimistic before it should. So coming through and looking through to those fundamentals is the most important thing in all of those scenarios and even now. So it's been a lot of ups and downs this year, but we're finally at a place where the fundamentals basically align with, or pretty much align with, where the market is and what's gone on in bonds and stocks. I'm going to say there's always that factor when we think about it. There is also some positive thinking there, right? It's not just all fundamentals today. We haven't finished the year. We don't know where all the things are going to end up. There's some uncertainty in front of us. The market generally has a somewhat positive view of the rest of this year going into next year. Otherwise, you wouldn't see the levels you're seeing. And part of that is a big theme that everybody talks about. You've heard about AI. Anybody know anything about it? Okay. You know what the letters stand for? Okay, good. That sort of investment, which is huge, right, is driving, it's an investment, one, that's driving business productivity. It's a spend by every business everywhere. We're spending on it. Royal Bank of Canada is spending on it, right? Walgreens is spending on it. Everybody's spending on this. That spend and the efficiency driven by that is a multi-year, multi-decade potentially, but it's a multi-year enhancement to margins, profits, spending. So it is doing a lot, putting a lot of money out into the system. That's a great thing, right? That's a driver. The other drivers obviously are, you've got some reshoring of assets. You've got a lot of things going on with the tariffs that are happening that are causing some investments there. You don't have any real negativity with regulatory environment or the corporate profits or the economy. So again, businesses are investing, consumers are spending. It all looks pretty good, and when they project out into 26, which is what the market really is doing, projecting out, they're not seeing any big negatives out there. So the stock market prices up. It's highly valued, or it's fully valued. My only worry with that, valuation never causes things to fall. The only reason the valuation is a problem is because it causes volatility. That's it, right? So if things don't exactly work out, you'll see a little bit extra volatility. But that's why we plan and why we diversify and why we have balanced portfolios, right? To make sure that when these events happen, everybody is comfortable, because we're going to do the fundamental work all the time. The hardest part about volatility is when clients that we work with get a little bit too concerned of it, very nervous about what's going on and want to do something about it that might not be the right thing to do, particularly given the fundamentals, but we're always going to focus on those. Okay, so anybody have questions? I just want to pause. I'm going to let you ask me questions, or I can continue on. Or I could stop if everybody just wants to eat. Go ahead. Go ahead, in the back there.
I never thought I would ever ask this question, but I'm glad you're here because given the volatility in the economy and the geopolitical uncertainty, is this a time for a lot more people than in the past to look at hard assets as a hedge against uncertainty? Specifically gold coins, maybe stick it in a strong box.
Yes, okay, all right. I like the gold question. We get that a lot. Gold has done very well. I can't deny that fact, right? It has gone up in value. We, as a investment manager, have not ever really had the, I'll call it the, had not really had an allocation to gold, right, of any significance for any length of time or any substance. And I think that's really what you need to have when you invest in gold, right? Because it's hard to buy when things are going haywire, because that's when people like to buy it, right? There's times when gold plus stocks and bonds are all going to go down because there's a priority on liquidity management, liquidity period. So gold is one of those things that I think people, if they like it and you want to hold on to it, we're happy to do that. But we don't see an allocation there at normally people want 3 to 5% as anything very, very useful in a portfolio context. It doesn't pay me a dividend. It's only for appreciation. And most of the time, I'm better off just taking that money, putting it in a bond, getting 4%, and understanding that that's a conservative investment, because most people want it as a conservative investment. If you want to own it as a speculative investment, or like me, my dad was a big coin collector, I have gold coins, like that's fun to do, and you can look at them and stuff, that's great too. I always recommend as a portfolio manager, you do gold with a market vehicle versus having it physically in your hand, unless you want to look at it and touch it. Because when you have it physically in your hand, one, transaction costs are very high going in and out of it. Two, if you get robbed, you have 100% loss, which is unlikely if you have it, locked into Pershing's custody. So those are the couple of things with gold. We just have trouble with it. Same thing with Bitcoin. I get that question a lot, cryptocurrency. It's very hard to determine, and crypto is a good example. What did that do in April? 110,000 to 80,000. It was down 30%. Like, that's not a good. People tell me it's a store of value. It's a diversifier. I only want assets that are in the downdraft of the down markets of April. I want something that holds value, and that's where you struggle with some of those assets. But like I said, gold is one where gold, cash, bonds, I think I put them all in the same category. And, there's cool coins if you want them. Anybody else with a coin? Yeah?
Yeah, so you mentioned Bitcoin. What do you think about stablecoin?
I think the entire crypto for us, right? I think this is going to be. I'll give you the corporate answer in a sense, not a corporate answer, but our investment manager answers. We don't see a position where it's going to be appropriate for like everyone in this room to have 10% of their money in stablecoin, Bitcoin, Ethereum, any of those. I understand why the people that are in it like it. I understand why it's promoted. I get the blockchain ideas. I get the disintermediation of banks and all the rest of that. I just don't know where that sits in a portfolio other than trying to think about it as some type of more speculative asset. And that is kind of fits in that bucket. At some point, it might be mainstream enough, and maybe, if we're all doing business in it, it might be something more, that appropriate for everyone. But for now, for us, it kind of sits in this kind of side area where we look at it all the time. We could potentially get investments in it, but we're not sort of there yet in a portfolio context as a productive asset. It's just very difficult to figure that out. By the way, it's the second time I got that question today. It's funny. I was driving and I got that question from someone. It was good. It's right in front, and I think the current administration really has pushed that out there in a big way, and it's on everybody's mind. But as an investable idea, it's tough for us to get our arms around that.
You mentioned AI. We were talking here before you stood up to start about the impact of that on job opportunities for entry-level people and different kinds of professions. What kind of indicators do you look at to see when that may have an effect that the grits will hit the pan, so to speak, in terms of the fundamentals in the economy.
So it's interesting from an investor perspective, right? What we're seeing is the benefit of it from a corporate perspective, right? It does things faster, easier, better, right? I mean, we can use, people use transcription services, right? Not that we had a stenographer in our office, but you don't need a stenographer anymore, that kind of thing. The transition and the impact of that transition might be over some extended period of time. It's very difficult to tell at this point how that would impact the economy, right? I guess this is a very kind of oldish example, but people said, well, what happens like all the Blockbuster videos close and everybody's streaming, right? So there's no more stores, you don't go into, and all those people lost their jobs. I don't know, people making the tapes, people doing the tapes, people working in the stores. Well, what happened? Did we see that? Like does a transition of technology cause this massive job destruction that's the hard part of that all, and it's hard to see where it ends up. So I think over the years we're gonna figure that out, but it will be for us a quarter to quarter type of analysis on the economy, on employment, on everything else. So again, you're not seeing it in the data today, right? The jobs numbers are fine. So let me stop for a second. Economy, corporate profits, interest rates. So now just want to talk about an investment, general dynamics, right? To your risk tolerance, you can be at your full weight in equity. You don't have to have less equity than you normally have that fits your risk tolerance. You don't have to have more bonds and less equity, right? We're advocating for be in the balance. When it comes to equities, we like the U.S. market. We've liked the U.S. market for a long time. We like the large cap U.S. market especially. We are interested in and looking at always medium, small, international, emerging markets. We just haven't gotten there for most clients on a broad level to making an investment in all of that. We're thinking about it, we're considering it. International being the biggest one of those, where international stocks for the first time in like a decade outperformed for a few months. Now we're caught back up, right? So it's almost like we have to have rationales for investing in equities or stocks or different categories of stocks as long as they can perform over time and do well and be diversifying and have competitive returns. We're happy to think about including them. But for now, we're very U.S. centric, and we think everyone can invest equities at their up to their risk tolerance for equity volatility, right? And we all know it can be high. And U.S. centric and large cap too is the best place to be because those companies are dominating all the big tech right around the world. When it comes to bonds, because it's a good economic environment, because we have good corporate profits, we're willing there, and you mentioned it, we're willing there to not just have traditional investment grade treasuries, corporates, munis. We also very much like higher yield, right? Take on some credit risk. You will get paid for taking on some credit risk, and the credit risk isn't that great because you have a very stable economic and market environment and economic environment. So taking on some credit risk. Clifford is a good example. That's a loan pool that yields close to 10%. High yield bonds is a great place to be, 6+%. So all of that sort of non-investment grade and even alternatives to investment grade bonds is a great place to be on the credit side because you can earn more. And I really like what we're seeing from credit because you're starting at 4, 4.5, and you're getting up to 5, 6, and 7, and in the case of some loan pools, even more. A very nice blend on the credit side can get you a great return in the near term. So equities at your full to your risk tolerance, bonds, but bonds diversified into some credit. And that's kind of our stance overall, and I think we're going to roll that into 2026. And I do think we will start to pick up. If things go well, tariffs settle down, trade wars settle down, geopolitical settles down, at that point, it may be something where we're thinking about more global and other areas of the world as investments on the equity side and maybe even on the debt side. Until we get a little bit more there, we're probably going to stay more U.S.-centric. I just wanted to give you our market commentary. Did I go over my time, or am I still good to take questions. Okay. I just want to make sure. I don't want to. I don't like to stand between dinner. You don't understand? Like, I'm a guest here. You invited me up. Like, they don't. Oh, that guy went on and on, Nick. You were so fast, and we got to dinner so much quicker. But I'll answer questions. Or if they want to serve, I'm fine too. I could stand and answer questions while they do it.
Well, I just have a question. I think
Go ahead.
something that people have always found a little bit interesting is, very specifically, are there companies that you guys are excited about investing right now, whether you currently have them in the portfolio and they're becoming a core, or it's something that you're keeping an eye on and, you know, if it hits certain metrics, it's coming in the portfolio? I'm curious about that.
You know, we I get this question. We like everything we own. Right away. Now, they all work? No, they don't always all work. So some analysts, we penalize them a little bit. I wish they got them all. I'd like to say that every analyst we've ever hired has always gotten their stocks right and they only go up. Unfortunately, that they don't all only go up. But, we've loved the big tech names. We've had them for a long time. We've invested in all of that whole thing, all those magnificent 7 stocks, we're interested in. We have big positions in them. We like healthcare. We were warming up to financials because of all the activity going on around the world. We like some consumer stocks, although we are trying to kind of be in between like the consumer cyclicals, which is what you spend a lot of money on, and the staples, right? So I think overall what we are trying to do, I think our central theme is, we have all the big tech, the NVIDIA, the Microsoft, right, and on, those names, right? And they dominate the market. We've been really on a mission, and you've probably seen this in the portfolios, right, to try to diversify around that, find other areas, find other companies, supplement that, because they're great businesses, but whenever you're that top heavy, right, you're very much exposed to singular management and what they do and what they don't do well. And we've been looking around, so you probably have seen this broader diversification, healthcare, financials, energy is another one that we've, Now, none of that, what I'm talking about, will ever be bigger in sort of positioning in anybody's portfolio than those really big, huge companies that are driving the economy, right? So when I say something like we like energy, I'm not going to have a position in 5 energy companies that's as large as the positions we would have in NVIDIA and Microsoft and all these companies dominating. That would be crazy, right? Because that's just too much. But we will have them at a greater maybe allocation than what the market would have them in. So yes, we're outside of that, those big themes, right? People are spending money. Healthcare's got a big lift going on. Financials are finally coming back because, as rates stay up, inflation comes down, lending gets a little freer, they do well, and that's been a good environment for them. So those are areas that we also like, and we are trying very hard to find names that are, going to do what some of these big tech did, but it's going to be tough. Going to be tough. Anybody, any other ones here?
I'll let you sit down. And
No, listen, I'm good.
Thank you very much.
All right. Thank you. I mostly gave good news, so you're clapping. I like it. Okay, good. And they didn't guarantee anything, so I'm safe.